everyone, this is Miltos Savvidis for Futex Live, and I'm doing my weekly trading roadmap for the week starting the 4th of May 2015. Um, so it was pretty much, for me at least, a 4-day weekend. Didn't come into work on Friday, and regrettably not today either, even though we have seen a few pretty nice market moves. I had some family over from the States, so um, I didn't come in for those 2 days. They were bank holidays, but we have seen some good volatility today in any case. I'm going to be going through from Tuesday onwards. Just to cover some of the weekend news, we did see um, the Greek talks make a little bit more progress. We did see a little bit of risk on flows today in some of the European indices, so any progress on that front is going to be pushing the European equities slightly higher. And we also saw the HSBC China Manufacturing PMI, which actually came in at a miss at 48.9 versus a 49.4, which was expected. Now, with these kind of figures, obviously any bad PMI prints out of China, at the minute it seems as if the market's taking as if when you do get this bad news, it kind of equals good news with regards to monetary policy um, out of China. They're looking a little bit more towards accommodative monetary policy if we start seeing worse prints. We've seen last month that triple R cut. We could possibly start seeing some some bigger moves if these GDP prints actually start coming in less than 7%. Last time we saw GDP came out 7% flat. If we start seeing that below 7%, maybe that could start pushing some real accommodative moves out of China. But at the minute, it looks like bad news is equal to good news because out of China, out of Asia in general, today we're pretty much flat or slightly higher. So it's not really digesting it as a bad news at the minute. And definitely keep an eye on these figures. They're going to be driving flows in the coming weeks and months. From Tuesday onwards, we've got the UK construction PMI data points, European PPIs, US services PMI, and the US ISM non-manufacturing. This being probably the most market moving out of the four figures that we've got, the four main figures that we've got coming out on Tuesday. And it's just taking a look at how the market's kind of panning out. And I'm looking at the Stoxx 50 on a daily chart. We can see we've started to break lower, and we've got a slight short-term bias to the downside with this head and shoulders formation. You can see the head here, the left shoulder here, the head in the middle here, and that right shoulder in here. That right shoulder basically formed below this trend channel, which we were sitting in for pretty much the duration of this year in 2015. We broke below that, as you can see on that day in here, and we consolidated just below. We came and tested that trend channel support, turns resistance a few days ago, really 3, 4, 5 days ago. And when we did test that, we started to make our way back to the downside. And notably, when we broke uh, last week to the downside, it was some pretty good volume. We saw some good flow, especially when we got through these 36.06, 05s area. Now that for me is really the pivot point that I want to be pointing out for this week. You can see today we started making our way to the upside, notably with Friday leaving a bit of a swing rebound. We had some weakness. We tested to the downside, found a low at 35.21, and we managed to close back inside that previous daily range. And you can see coming into this week, the market's probed slightly to the downside, found a bid down by these lows of Thursday, and we've kind of started drifting back to the upside. Now, for me, this area, these 36.06, 05s area, is a pretty key area. We've got that daily low in there, but that was also our closing gap, which it seemed to me on that Thursday when we were getting to that price, there's a lot of activity, especially at those 36.05s. A lot of volume going through. A very big buyer sat at that price, and when we did finally get through it, it did really start going. So that's really a pivot point for me, going forward. And if we take a look on a market profile structure, this is the weeklies, and I've kind of scratched that up to uh, two prices. So basically every time that the TPO changes two prices, so from 82, 84, 88, 86, 88, 90s. That's how I'm kind of looking at these profiles, just because on the elongated version it's hard to see it all. Um, but for me, the way I'm looking at this at the minute, other than this pivot point at these 36.04s to 06s, um, which we can see has kind of held us to the downside for today, we've got this very big gap and cave in time value. I mean, we do have especially low volume we saw between these 05s and about these 84s, 86s, which we've basically filled in today quite nicely. But in time value, we've got this very big cave that really takes us all the way back up to the value area high of the week at about 36.58, which is also pretty much coming into the higher TPO count for this value area region. So as it stands, I mean, the way these caves trade out and the way we've seen it trade out in the Euro stocks, it usually tends to find a bit above the lower bound of this cave. And when I say that, I mean it tends to find a bit above, well, the VPOC and the POC of this area. And once it starts finding that bit above there, it should theoretically start filling it in, testing to the upside, possibly even coming through um, this area, this region here. But if we do possibly get back up here, and obviously what we need to see is a close above these 36.05s, 06s. Well, if we do start getting that and we start seeing that price action back in here, I don't see a reason why we can't make our way higher and possibly test this value area high. For me, obviously I'm going to be looking at this area for resistance, but I would also like to see how it will react around these 36.64s to about 66s. In this area, you see there's a little bit less volume in there, and I like that just because if this is that volume block that we're seeking as a target, if you were taking this trade, last time we saw that, well, basically last week we saw this filling in of the cave. It basically came to the other side of a low volume node and then started to rotate back down. So that I'm going to be looking at that area if we get back up here. Obviously, that is a big if. If we can't get above these areas, well, really, and we get capped at these 05s, 06s, there is obviously scope for this market to break lower. But having said that, we are still firmly within last week's value area. Once we start offering below this buying tail in here, particularly below these 35.32s, and these 35.42s in here, which is very close to the close of last week. And once we start finding a little bit of value down here, then I think I'm going to be slightly more bearish just because we can't fill in this cave to the upside. But as it stands right now, I think the hypothesis for me is as long as we're holding above this area in here, particularly, we've got these 74s to 82s area in here. Yeah, I'm liking it above this volume, this big volume block over here. So if we hold particularly above these areas, I'd like to see this kind of fill up to the upside. That's just a hypothesis. I'm not particularly playing this from a longer term view, but if I do see it above here, then I'll kind of play it more from that angle. Again, I am being very wary. We are still in this head and shoulders pattern, so there is going to be sellers if we start moving to the upside. There's going to be sellers stepping in, and particularly I would note wherever that comes in. Obviously, at this point, I come around these lows of the days in here, the neckline test. But bear that in mind if we do get up to these levels to see the reaction around this neckline. If we do see any strong sellers step in, that could be your indication as to whether we hold this little short-term trend to the downside. Now, with the Bunds have been particularly interesting as of recently. And just, I mean, instead of putting up a price chart, I think I've just put up the yield chart just because we're dealing with such massive moves at the minute with in the Bund that I feel certain levels are actually getting negated altogether because we're seeing such strong flows, and it seems even from the cash market, you know, The cash market's really moving this, where we're seeing paper come into the market, sell side paper, whether they're initiating shorts or they're getting out of their longs, which most probably it's in my opinion mostly longs liquidating. Um, it seems there's a lot of flow on the cash side and paper side, so I'm paying very close attention to the yield charts. Obviously, when I put this little presentation together, we were trading just below that key 43 basis point mark. You could see the moves that we've had from the low we made at basically 5 basis points. You know, we made that low about 5 basis points or 4.9 basis points. Started making our way higher. We flagged in here. Saw a huge move to the upside. Broke back inside this box. I mean, this is a box I pointed out. I think I posted it even on Twitter. You know, once we started breaking back into this value area, box area, you know, the logical target was for this to vacuum and make its way to the other side. So we did test that 40 basis point mark. We, you know, melted through there as well. And, you know, as it stands right now, we've actually come through this 43 basis point mark as well, which was really my next real area of support in price and resistance in yield, because that's the upper end of this little box region. Now, if we're starting to hold above this area, above this 43 basis point mark, well then again, this market does look like it can continue. You know, we're in this value area region now. It this you know, there's nothing really holding this back from having another leg higher up to these 56 basis point mark, which is really the next area of resistance in yield or support in price. We've seen that swing low, a couple of swing lows in here, and we just we blew through it on this day, but that area pretty much held us. So really, that's the next real area. I was looking at these 43 basis point mark. We stopped there relatively shortly today, but we've kind of come through that now. I think we're trading just above that at the minute. But what I would really like to point out, and a number of people are probably asking questions as to why we're getting such massive moves in the bunds, and that there's probably not one particular reason. Even it seemed as if the move kind of coincided with when Bill Gross started saying, bunds were the short of a lifetime. Now, whether that's the reason, I don't think so. Whether it contributed, possibly, yeah, probably it did contribute. When the bond king comes out and tells you, this is the short of a lifetime, and you're seeing never before seen low yield, unprecedented low yields in the bunds. People that are buying all the way up, at those prices, and you see a very reputable investor come out and tell you, this is just ridiculous. Possibly you want to start, taking some money off the table. But what was really interesting to me is to look at, these 5-year inflation swaps, the euro 5-year inflation swaps. Something that a lot of us, a few techs, been talking about. I've been talking about this for quite a while now, and it seemed to me, for pretty much, it seems as if since mid Q1 2015, or at least the latter end of Q1 2015, we started getting a bit of divergence in this. And when we started breaking down in this 5-year inflation swap, which is basically the medium-term inflation expectations of the market, we did see a strong correlation. This is the correlation between that and the Bund 10-year yield. And we saw a very strong correlation start to build between these markets. As this started coming off very, very aggressively, the bunds just kept going higher and higher, and yields were compressing lower and lower. So as this would come down, the yields would go down. And it seemed at some point, after QE was announced, they began to diverge a bit. Bund started, going basically going lower and lower in yield. And around these areas in here, I think somewhere in here, you see the 17th, in the 17th of April, we actually made our low in the Bund yield. So that was our low in the Bund yield when the 5-year inflation swap had been nowhere near to its lower price, its lower end of price, which was somewhere around the mid 155s, 154s ish. so around that area, but we were really nowhere near that recent low. So there was you could see there was a bit of divergence. The correlation was slowly starting to break down, but I kept saying in my trader news, trader views, and some of my weekly roadmaps, my key level was really these 173.89s, which we saw some strong resistance in price around these levels, which we couldn't really close above it. Last week we finally got a close above this area. Whether this is a reason for the Bunds coming off, I'm not sure. I mean, I'm not one to say there's a particular cause and effect here. You know, maybe it's not due to this. Maybe it's the Bund that's driving this 5-year. But there, notably, anyone can see that there's been a divergence. So since there's been a divergence, and this is slowly looking like it's bottoming, we've had, you know, if you can even trade this as a normal market, which I'm sure a lot of market participants are probably trading this like a normal market. This looks like an inverse head and shoulders. And since we started bottoming out here, we've kind of, you know, made our way even higher in inflation expectations. The bonds are trading at just ridiculous prices, really. If this is going to start making its way back up to a more normal 2%, or at least close to that area, the bonds really shouldn't be trading anywhere near where they're trading. Regardless if ECB is doing QE, why would you want to hold 10-year bonds if inflation is, in the medium to long term is going to be at 2%? It just doesn't particularly make any sense. So there is definitely, I think, scope to be looking at this 5-year inflation swap to see if we are going to start consolidating about above here and making our way back to the upside. Taking out these key support slash resistance areas, or previous support slash resistance areas at these 1.8% areas. Again, coming close to these 1.9s, and then higher up these 2%. So keep this chart in mind. It could be something very important if you're trading the Bund in the short and medium term. Definitely something to keep an eye on. Come Wednesday, we've got the Chinese HSBC Service PMI. Again, something to keep your eye on. A little less important than the manufacturing PMI, but again, it's important to keep an eye on this to see if it goes into contractionary territory. European Services PMI, the European retail sales, US ADP employment, which as of late hasn't really been notably showing us any correlation with the NFPs, but we have seen some small market moves. Watch out for that number. And of course, on Wednesdays, the DOE crude oil inventories. From a central bank policy perspective, we've got the Fed's Yellen. That's the Fed chair. She's a voter and a leaning dove. Fed's George, a non-voter and a hawk, and the Fed's Lockhart, who's a voter and classed in the middle of the hawk-dove spectrum. Looking real quick at WTI crude oil with respect to our DOE crude oil inventories coming out that day. We've seen WTI crude oil start moving, making its move to the upside after a very, very, very sustained bear trend to the downside. We marked our swing low at 42 bucks, and since then, since we've got this pretty much big, bullish engulfing candle, the market started to make its way up. We've had numerous stories: the Yemen crisis, also Shell buying out BG, which I went through in my trader news, trader views. That was basically a huge signal in the market that Shell was taking a view on oil. They saw value in BG. They saw there could be a market turn, and really ever since then, which was around these areas in here, the market has made a significant move to the upside. And these are the kind of things you have to be very wary of. The oil industry is a very, very much insider industry. They know the ins and outs of that industry. So when a company like Shell, which is one of the biggest oil or energy companies in the world, buys out another oil major, you want to be very, very attentive to these markets, because that was I think a huge message in this market. Now, whether this is going to continue so aggressively to the upside is yet to be seen. We've seen a little bit of selling pressure now on Friday and today. Notably, obviously the big break was above these 54.24s, which is a very, very key resistance point. And the next real resistance that we came to recently was these 58.98, so basically these $59 marks, this $59 mark, which we came through. We tested this $60 mark um, last week, and we're finding a little bit of sell side pressure. Now, if we can't really sustain a bit above here, I'd expect us to slowly make our way lower and possibly auction off these areas between 56 and 57 bucks. Just because you can see in this area and here we had that pretty, it looks like a very nice consolidation, a nice little value area with a sell side tail and a buy side tail. It seemed like there's good value to be had between 56 and 57. So if we do see sell side action, I'd expect it to come test and auction off in this area. Now, whether we can sustain the bid at these areas, that's yet to be seen, but ultimately my strong area of support is going to be these 54 bucks, without a doubt. That is going to keep my medium-term bullish bias intact. Below there, I'm probably going to be slightly, ever so slightly, um, you know, bearish, just to have that move down to possibly these $50 marks. But definitely, once we get below that, we're probably looking a lot more neutral than anything. At the minute, it looks like we could make our way higher. Now, in this scenario that we start closing above these $60, 59, $60, the next real area of resistance is these 63.72s. So a very strong reaction off of this area. When we came and tested it again, we didn't particularly show a huge reaction again, but I would expect that to cap the market if we get there very quickly. That's probably a very key area to keep an eye on. Moving on to Thursday, with the Australian employment numbers, that's going to be pretty key because on Friday we've got the RBA monetary policy, well, the RBA's monetary policy event. So that is really going to be at the forefront of people trading the Aussie or the Aussie bonds. So if we do see employment tick up as good as we saw it last month, because last month we saw a very, very strong jobs number. Now, jobs numbers, if they're as strong as last time, I think we could start paring back again those rate cut expectations, because at the minute there's this bias for a rate cut in that from the RBA. Now, again, if we pare back a lot of those gains and we see a very weak number, I think we could see a lot of scope for a big move in the Aussie dollar, which I'll cover in a second. We also have German factory orders and German construction PMI, and then on central bank policy perspective, what the ECB's Mersch speaking. From a geopolitical standpoint, the all-important UK general elections are on Thursday, so we'll be getting basically the polls over Thursday and Friday. So 100% you need to be keeping an eye on this. If you're trading the cable or the gilts, for example, the main risks, I think, of this general election, and if you read the ITC rundown on this, they've got a very, very good rundown, pretty in depth. So I'm not going to cover it too much in depth. I'm sure some of the guys, possibly Brannigan in his debriefs, might go through this a little bit more in depth. Just from my scope, I'm just going to cover some of the risks. The main risk is basically if we get a hung parliament. And a lot of the market participants probably going to look at the risk of an EU referendum, possibly if UKIP are part of the coalition, or if they actually do make a coalition. Now, the risk of a coalition with these smaller parties, looking for more expansion in their areas, that could have a bit of a risk to more fiscal expansion. Now, what we could get from that, if there's a little bit more fiscal expansion, we'd probably expect a little bit more supply out of the UK. That could be possibly quite negative for the gilts, so the gilts might suffer from that. Keep an eye on that if we get any price action with regard to that scenario. And the other real risks are going to be the type of government we have, the time it's going to take for it to form. Obviously, in 2010, when they formed their coalition, they did it quite quickly because we were in the midst of a crisis in Greece, a European debt crisis. Markets were going pretty much nuts at the time, so they had to do it really, really quickly. So I'm not sure if they had to make a decision now, they would do it so swiftly. So it could take a little bit more time. Thus, there'd be a little bit more uncertainty So that could be interesting how that plays out, possibly quite negative for the cable. And of course, the stability of the actual government that's put into place. Now, if the government gets put into place and there's a risk of it blowing out after 7 or 8 months, well then obviously there's going to be a lot of premiums getting priced in again in your cables, your gilts, etc. So definitely keep an eye out on some of these risks out of the UK general election. The results are going to be coming out basically Thursday and Friday. Friday, really you're going to get a little bit more of a solid idea of where this is going. But something very interesting to follow. Now, back to what I was talking about, the Australian employment numbers. If we take a look at the Aussie dollar, with regards to the US dollar against the US dollar, we've seen recently the backdrop is that the US dollar, has been quite weak in the recent days slash weeks. So there's been a bit of a profit-taking theme in the US dollar. Notably, the euro seems to be the one gaining the most out of this to the upside. Also, the pound was up until 2-3 days ago was very very strong as the dollar was selling off. It seems like the cable's kind of pared back a little bit, which I'll go through in a little bit now. But the Aussie dollar seems to me that notably, as the US dollar's been weakening, this one seems to be the weakest one against the US dollar. So it seems to be, from what the price is telling me, a bit of positioning in this market. It seems that certain market participants are actually selling this market a little bit more than the others. So there seems a bit of positioning, because generally there's the US dollar theme of weakness, and this one is, in the past 2-3 days, has shown particular weakness compared to its other peers. So that's the backdrop at the minute. The market seems to be favoring in the short term, even though we've had a very strong run up. And we've had this triple bottom. Yes, we've had this triple bottom. In these price areas, we had the good employment numbers. We didn't get a rate cut. Obviously, we started, making our way to the upside. We found some very strong resistance at these 80.31s and 80.75s, which was this previous low in here, and then a couple of opens and closes, another swing low at these 80.75s, which has pretty much held us at the minute. And the way this is looking for me, if we do get worse than expected employment numbers, I think they're going to start pricing a little bit more aggressively for possibility of a rate cut. Maybe those numbers that we got last month were one-off, and if we do see that, worse numbers this month, possibly this could give this market scope. If we start closing below this trend line in here to the downside, we could see this I think easily test these 75.50s, which was our triple bottom. And this notably doesn't look like a very great low. But again, if we do see those worse numbers, I'd expect that to auction quite quickly to the downside, especially because the Aussie dollar seems to be slightly weaker in the past couple of days. On the contrary, if we get a continuation in the good jobs number and we hold above this area, which we are in a critical area at the minute, and especially if we hold above these highs in here, we could start auctioning, maybe possibly, from the looks of it, consolidate in this region. Again, if we close above these areas, these key 80.75 areas, well then we're back into this value area region, and we should, auction higher, possibly test these 82.95s, and find some value in these areas. So that's the way this market structure is looking. If we take a look really quickly at the cable, in recent weeks, you can see, and this is a daily chart of the cable, in recent weeks you've seen the market push higher very, very aggressively, but we've found quite a bit of resistance at these 155s again. And this is a level that, I pointed out quite a while ago when we came and tested it after we completed this inverse head and shoulders pattern around here, but we've tested it very, very nicely again 2-3 days ago. So we've come to that area. We've sold off quite aggressively to the downside. Possibly some market participants saw that we were underpricing any risks of the UK general election, but it seems with this kind of sell-off and this kind of bid from these areas, we could be quite volatile in this region, possibly filling out this area. But again, the market's going to be looking at some of the risks that I mentioned previously. The main area for me, and I've pointed out right here, these 149.86s. These previous swing lows in here, a lot of swing highs in here. So for me, if we're holding above this area, or pretty much the 150 area, that's that's for me an indication that possibly want to continue auctioning higher. On the contrary, if we start closing below that, again, that is that's a line in the sand for me. We could start auctioning lower back into these value area regions. Moving on to Friday, we see the chunk of the data, or the biggest data for the week. We've got the German industrial productions in the morning, but most of the market's going to be waiting for the all-important U.S. non-farm payrolls, which is expected at 220,000. The U.S. unemployment expected at 5.4%, and then the very important U.S. average hourly earnings as an indication of possible inflation pressures. We're expecting that at 0.2%. Now, with the market, obviously, last month we had a very, very big miss in this figure. A lot of the market participants are possibly attributing the fact that we've had a lot of bad weather in the U.S. this year. They're always going to use that as an excuse. So really, if that's a one-off, we need to see this trade back to I don't know, whatever the 6-month average is, which is probably closer to about 260, 250, 260. So if we get somewhere around that average, I think maybe we could see a little bit of unwind in any of the pricing that we saw from the last jobs report. So bear that in mind going forward. From a central bank policy perspective, we've got the BOJ's minutes, the RBA statement on monetary policy. Obviously, like I said, I think the jobs numbers are going to be quite important coming into this monetary policy. I haven't looked at what's priced in. Last I checked, there was 50 or 60% chance of a rate cut. I have to check that again. But if, for those of you at Futex, you'd probably want to ask Imran. Imran's probably the best equipped to tell you about the RBA. He used to trade Aussie bonds, obviously, for a very long period at JP Morgan. So definitely hit him up for any suggestions on that monetary policy. I know I will. And then we've got the ECB's Constancio, again, on Friday speaking. From a market structure perspective, I think by Friday a lot of the market structure probably changed given the volatility, but I do want to take a really quick look at the dollar. The dollar, in recent trade, this is a monthly chart of the dollar. You can see we pretty much found resistance at about 100 on the index, or just above 100 really. And I wanted to put this into perspective for you guys on a very, a longer time frame. And going back, we can see the key areas of support and resistance we saw was these 97.32s, which were obviously below these 96.17s. We had some swings in there, which actually that was the recent swing low that we took out, and we've seen some weakness out of that. But really what I wanted to show you guys was these 92.29s. We've got some swing lows in here, some swing lows and swing highs in there. Most notably, the recent swing highs that we took out, the latter end of 2014, and we really haven't tested that area. For me, once we broke above that area, we were trading in this value area region, and we really haven't tested that area. Now, what's interesting is, and unfortunately, it seems to have cut out from when I snapped it from Reuters, but the 32.8% fib, the 32% fib from this massive move that we've seen in 2014, that comes in at about $92, just short, maybe I think 91 something. I've got to check that again, but it's really very, very close to this area, to that very strong area that I would be looking at in any case. So at this point in time, we haven't, obviously, we're seeing this profit-taking theme. The trend is firmly higher. For me, I think this area could be a very, very interesting area. Should we get further profit-taking and the move continue lower and lower, that I think that's going to be an area for me that I'm going to be looking at very, very keenly. And the way to trade that, obviously, at the minute, if you ask me, I'd probably say, okay, the market to the major FX pair to short would probably be the euro, because that seems to be the strongest one. Um, sorry, not the euro. The euro seems the strongest, and that's not the one you don't want to get in on. But you probably want to look at one of the weaker currency pairs, like the Aussie dollar, for example. So if we get into these areas, particularly, that is going to be, those are going to be that's going to be the trade you want to be looking for. Um, so for me, that's going to be a very, very key area. Now, obviously, if we do get weaker numbers out of the out of the U.S. on Friday, so the NFP, particularly if we get something below 200, something that confirms the last job number, we could see this market, continue its move to the downside. I think this market could find a bit of a floor around this area. So I'm just pointing that level out, and I don't usually point out levels with any sort of massive conviction, but it seems to me this area could be quite interesting just because of the technical confluence. So definitely keep an eye on that that little chart structure in the dollar index. Looking at risk and money management plan, obviously this is mine, so I wasn't trading on Monday, so I'm doing it from Tuesday onwards. There's 4 venture-in risks on Tuesday, 8 on Wednesday, 5 on Thursday, and 7 on Friday. The relevance of which, in order, are medium, medium, high, and high relevance to the market impact. The way I'm allocating my risk is 20%, 20% Tuesday and Wednesday, and 30 and 30% on Thursday and Friday. That's just because the relevance seems to be a little bit higher with Thursday's Aussie employment numbers and the U.S. employment numbers. Are quite relevant to their respective markets, and this is the way I'm going to be planning and structuring my week from a risk and money management plan perspective. Hopefully, you guys do something. Um, well, write out a plan for yourselves. It doesn't have to be similar to mine, but have some sort of structure around how you're managing your money, because that is extremely important in this game. Right. Well, thank you very much for listening to this weekly roadmap. It was a little bit longer than usual, but I hope you guys have a great trading week. There's a lot of volatility to take advantage of. Be prepared, be passionate, and be at your desk more often than you usually would. Eat at your desk. If you have to piss earlier in the morning, don't wait until there's trades to be had and there's market events. Don't be walking around during the numbers. You have to be disciplined and routine about this, because the market is moving at the minute and you can make a career from this. So, wish you guys all good luck, and I'll be speaking to you again on Friday. Take care. Bye bye.